It's the day after Thanksgiving, 1996, and Ken Fox and Walter Buckley walk into their boss's office at Safeguard Scientifics to pitch him on making a $5 million investment in their new fund. The intent of the fund is to act as an incubator for internet companies specifically in the B2B space. Boss tells them he doesn't want to, but he's giving them the old reality TV rope-a-dope. He wants to give them $15 million, and he says they should raise 40 instead of the 20 they'd been hoping for. Comcast and Compaq help fill out the round, and just like that, the fuse is lit. Internet Capital Group, or ICG, will fly high and crash hard. Were it not for its lack of a sock puppet mascot, it might be the poster child of the tech bubble of the late 1990s. Well, that and one other very important factor. After raising that $40 million, ICG hit the ground running. Some of their first investments were with Water Online, which became VerticalNet, and MatchLogic, the latter of which they were able to 5 times their money on in 2 years by selling to Excite. On the back of that early success, they raised another private round of funding. More big names came in, including GE Capital and IBM. Later, Ford, AT&T, and DuPont all made investments before the company had even gone public. Things really started heating up for ICG when VerticalNet, that they held nearly a 50% stake in, went public. On its first day of trading, shares rose 180% and the business reached a market cap of $1.6 billion. This was a critical moment because it put the world on notice that the internet wasn't just B2C companies like eBay or Yahoo. B2B companies could make people rich as well, and Internet Capital Group held a full stable of investments in those companies. Soon enough, it was time for ICG to go public themselves. In August of 1999, ICG IPO'd at $12 per share, a figure that doubled by the end of the first trading day. By September 1st, shares were $40, and legendary value investor John Neff takes a rare short position in the stock. His courage proves disastrous as prices reach around 50 in October and 90 in November. Around this time, Buckley said it became obvious that something was wrong. He said, "Most meetings we went to were standing room only, and as we left, they wanted our autograph." He even tried to talk to Henry Blodgett, chief internet analyst at Merrill Lynch. Blodgett, most recently, is infamous as the enemy of Barstool Sports' Dave Portnoy.
So Henry Blodgett, the scumbag CEO of Business Insider.
And previously, as I've done a video on, was cast as a villain because he gave high ratings to stocks and companies even though he thought they were garbage. With regards to Internet Capital Group, Buckley basically asked Blodgett to place a neutral rating on the stock of his company while shares were trading at 80. Since Blodgett never said anything but buy or strong buy, though, he told Buckley, "I think we should just let the stock go where it goes." And where it went was straight up. Shares finally peaked at a value of 212, equivalent to a market value of $60 billion. ICG was the third most valuable tech company in the world after AOL and Yahoo. Then reality began to set in. Not only was the tech bubble starting to show cracks, but insiders who could see the bubble bursting were all going to have their shares unlocked in February. Many planned to sell as soon as they could. Prior to the unlock, shares were still in the triple digits, a 50% fall from the highs, but still a better than 600% gain from the IPO. But as the insiders dumped, the market implosion truly took over. In April, shares touched the 40s, and John Neff closed his short position. That's right, if you think that diamond handing means holding shares that could end up going to zero, then there needs to be a different term for what Neff did. His return at peak was negative 600% in just 3 months. The trade is quite possibly the hardest 25% short-term gain anyone has ever made. And tragically, as early as he was on the entry, he was just as early on the exit. Shares were 10 in November, and soon were flirting with falling under $1. 2 years after the IPO, the market cap of ICG was $200 million, down 99.5% from its peak. Suddenly, never mind the stock, ICG the company was in trouble. They had a portfolio of unprofitable companies who needed influxes of cash to keep the lights on. Buckley says they were burning over $100 million in cash per month feeding them, which was no longer sustainable. They'd have been able to raise some money at the top, but not nearly enough. And if ICG wasn't going to give it to them, then no one was. So one by one, these businesses started to fail. Most of their advisors told Internet Capital Group that they too should consider filing for bankruptcy. It was inevitable, so basically just get it over with was the logic. But Fox and Buckley had other ideas. They just had to figure out a way to get out from under a debt burden worth hundreds of millions that they'd issued in one of their financing rounds. Luckily for them, their debt holders all assumed that ICG was about to go bankrupt as well. This meant that they could go out and purchase that debt on the open market for pennies on the dollar if they were quiet about it, and they pulled it off. Executing on 200 or so transactions, the debt was gone and suddenly they had a chance. Next, they refocused. Instead of taking minority positions in dozens of companies, they would take much larger stakes in just a few. And then for an entire decade plus, they just went about their business. They sold Logistics.com in 2003, Channel Intelligence in 2013, and Folio Dynamics in 2018. If you bought at the top, sure, you got killed. But if you bought at the bottom, you actually did quite well. Rebranded as Actua, symbol ACTA, you can find coverage of them on Seeking Alpha, starting way back in 2005 and ending in 2018 when they didn't go bankrupt, by the way. They just wound down operations and existed solely to sell off portions of the remaining investments. Every bubble has winners, like investors in Internet Capital Group's early funding rounds who sold as soon as they could that February. John Sheehan, who worked at ICG in a role described simply as a troubleshooter, which seems to mean an old janitor, picked a decent time to retire. And though he sold nowhere near the top, he did garner $225,000, an amount that transformed his life. For a while there, I could have been really rich, he said, but I am rich relative to the expectations I had set for myself as a young man. Comcast was another big winner. They took $400 million off the table before the position collapsed. On the other hand, there are losers like Jim Landis, owner of the deli where Sheehan and his coworkers lunched. He bought 2,500 of ICG stock on the open market and held it all the way up. Soon, he found himself with only $250. Internet Capital Group itself doesn't really fit into either camp. They didn't emerge from the ashes of the internet bubble like Amazon, nor are they remembered solely as an object of ridicule like Pets.com. In the end, they're probably most notable for a combination of two things: the heights to which they climbed and the way they managed to survive the fall. Thanks for watching, guys.